Stop what you're doing and look at what just happened to silver. In less than a day, it went from trading above $93 an ounce to the high $80 range, about a 4% hit. That is not a healthy pullback. It is not simple profit taking. It is certainly not the market calming down. That is one of the world's key monetary metals yelling for attention while the rest of the screen pretends nothing is wrong. If your wealth lives in cash, in government bonds, in a pension fund, or in a stock portfolio, this is not background noise. Moves like this are how a debt-soaked system quietly decides who gets paid back in real purchasing power and who gets paid back in diluted money. Over the next few minutes, I want to walk you through a simple 5-step playbook that sits behind moves like this and how it quietly rescues the biggest banks. Then I will show you a few clear signals you can watch that tell you when the fight has shifted from the number on your screen to a scramble for actual metal. Now here is the bigger question behind that one-day drop. Why is silver bleeding in the middle of a bull market? You have a metal that has doubled over the past few years and is still in a powerful uptrend. You have gold carving out new highs. You have major stock indices hovering near their peaks. And even the main silver fund is pressing into fresh high ground. On the surface, that is exactly what you might expect in a late-stage boom where easy money floats almost everything at once. So why do you keep seeing these sudden, violent drops in silver that seem to appear from nowhere, often in low liquidity hours, while gold, stocks, and even most other commodities barely move? Why, at the same time, has physical silver in places like Shanghai been trading several dollars above the Western paper price, week after week, in one of the most persistent east versus west gaps in recent memory? And why are serious analysts talking about years of structural deficits, drained vaults, and episodes of backwardation, where the spot price trades above the nearest futures month, something that is not supposed to happen in a market that is well supplied and calm? The official line is always the same few words: volatility, profit-taking, rebalancing. The unofficial explanation, though one that actually lines up with the pattern on the tape, looks more like a 5-step containment plan. I want to start with the first step, which you have just seen in real time. Silver pushes into fresh record territory, and instead of easing lower during normal trading hours when there is plenty of liquidity and genuine price discovery, the biggest red candle of the week appears in the quiet part of the session. Price drops sharply while gold barely reacts. The dollar does not explode higher, and the main equity index drifts along as if nothing important has happened. That is your first tell. In the futures world, trading volume and depth are not spread evenly through the day. The main silver contract trades almost around the clock, but most of the real depth is during New York hours. Once you move into the late-night graveyard shift, the order book thins out. There are fewer market makers, fewer large counterparties, fewer standing bids. If you dump a large block of futures into that thin market, you're not trying to get the best sale price, you are trying to get the maximum price impact. It is like trying to sell a skyscraper at a garage sale in the middle of the night. You are not doing it because it is the smartest way to sell a building. You are doing it so that when people wake up, they see the whole neighborhood marked down. Now add one more layer. In the background, margin requirements on silver futures have been moving higher, and we have seen cases where smaller traders were forced out because they could not meet the new collateral demands. Put those pieces together. When you see a large percentage move in silver, concentrated in a thin trading window on top of tighter margins and heavy speculative positioning, you're not looking at natural two-way trading. You are looking at the first stage of the pattern, a deliberate shove to knock price off the highs, flush out weak longs, and send a message before the next stages begin. Now, the second stage is what happens when you stop looking at the chart in New York and pay attention to the price on the other side of the world. In Asia, and especially in Shanghai, buyers have been willing to pay several dollars more per ounce than the Western futures price to get actual silver delivered. In a normal market, that kind of gap should not last. If silver is $90 in New York and $97 in Shanghai, professional traders are supposed to do something very simple. They buy metal where it is cheap, ship it to where it is expensive, sell it there, and lock in the spread. That process is called arbitrage, and when it works, the two prices quickly meet in the middle because every bar that moves from west to east pushes the cheap price up and the rich price down. So if that gap refuses to close and stays open week after week, it is not a bit of random noise. It is a warning that there is not enough metal available at the Western paper price, or that what is available comes with delays and conditions that make it less attractive, or both. Critics call this the Great Divorce, where the number that can be pushed around on a screen in one time zone starts to drift away from the price that real buyers are willing to pay to take bars off a loading dock somewhere else. It also tells you that the flow of metal is one way. Ounces are leaving Western storage and ending up in stronger hands in the East that are less likely to sell back into the futures game. The third stage shows up in the shape of the curve between today and the next delivery months. In most commodity markets, buying for later costs more than buying for now because someone has to pay for storage, insurance, and financing. In silver, whenever the market gets really tight, that curve can flip. The near futures month trades below the spot price. Traders have a blunt word for that pattern. They call it backwardation, and it is one of the clearest signs that people do not trust future delivery. They want the metal now. To picture it, imagine your favorite band playing 2 shows at the same arena. Tonight's ticket is $500. A ticket for next year's show, same band and same seats, is $300. The only reason tonight costs more is that people are not sure the later promise will be kept. Maybe the band breaks up, maybe the tour is canceled, or maybe they simply care more about being in the room now than about saving $200. That is what backwardation looks like in human terms. In silver, it means industrial users, refiners, and serious stackers are willing to pay extra to move to the front of the queue and get bars today, instead of trusting that 3 months from now the market will be calm and liquid. For institutions that are short futures contracts, especially the ones that expire soon, this is where the trap closes. Rolling their short positions forward becomes more expensive. Delivering physical metal at the lower paper price looks worse and may not even be possible if they cannot secure enough bars. At that point, the problem is no longer an interesting detail for traders. It is a sign that the people who promised silver for later are being squeezed by those who insist on silver right now. If this still sounds like abstract market talk, zoom out and look at how this pattern has played out before. In the late 1970s, the Hunt brothers pushed silver toward $50 an ounce by buying huge amounts of metal in futures. As price went almost straight up and real bars became scarce, the exchange did not stand back and watch. It changed the rules. Margins were raised again and again, new buying was restricted, and trading was limited to getting out of positions. The price collapse that followed was not driven by a sudden lack of interest. It was driven by the plumbing being rebuilt in the middle of the move to force people out. Go back to the London gold pool in the 1960s. A group of Western central banks agreed to feed gold into the market to hold the price down. On paper, it looked clever for a while. In reality, it simply drained their vaults faster until the flow became intolerable, the arrangement broke, and the monetary system had to be redesigned. Even in 2011, when silver made another run at $50, the response was familiar. A quick series of margin increases on the futures exchange turned a rush higher into a sharp collapse. Different decades, different names, the same bones. Price pushes higher, real metal gets tight, and the people in charge reach for rule changes in the paper world to slow things down. It works for a time, until the loss of actual metal makes the rules themselves hard to defend. What you're seeing now is not a brand new tale. It is the 2026 chapter of an old story. Now step out of the trading pit and into a boardroom that depends on silver. If you run a solar manufacturer, an electronics plant, or a business that builds power systems for data centers, silver is not a hobby asset. It is a basic ingredient. Without it, product does not leave the factory. In that setting, the kind of market we have just described is not an interesting chart. It is a direct business risk. When your purchasing team cannot reliably secure metal at the quoted Western price, you face 2 bad choices. You either pay closer to the higher physical prices that strong buyers are setting elsewhere, or you slow production and reshuffle projects. Paying up squeezes margins or forces you to raise prices for customers. Slowing down means missed deadlines and angry clients. Either way, stress that began on a futures screen shows up in earnings calls and in decisions about where to invest. That is how a technical detail in a commodity market becomes something ordinary people feel. More expensive silver feeds into the cost of panels, gadgets, and infrastructure. Over time, that leaks into energy bills, device prices, and the cost of rolling out electric vehicles and server farms. So when you see a market that prefers metal now, overpromises later, and pays a clear premium for immediate delivery, understand what sits behind that. It is not just traders arguing over a ticker. It is the first stage of a wider supply chain squeeze in technologies the modern economy leans on every day. The next stage shows up in the options market. If you look at the silver options list, a lot of call options cluster around big round prices on both futures and the main silver fund. Many of those calls were sold by large banks and market makers. By selling them, they agreed to provide silver exposure above those levels of price moves there. When silver charges up through one of those crowded prices, the sellers of those options are suddenly in a difficult position. As the price rises, they have to buy more futures or more fund shares to hedge the risk they took on. That extra buying can push price higher still, which forces them to buy even more. Traders call this a gamma squeeze, a feedback loop, where hedging demand chases the move. In silver, where the base market is already tight, that can be very violent. Now join this to what you already know. Imagine you are a large player who is short a lot of silver through futures and options. dealing with tight physical supply and all the stresses we have just walked through, while the price marches toward those crowded option levels. You have a very strong reason to try to keep price below those lines as expiry approaches. The tools are familiar. You return to the same tactics you saw in the first stage. Use thin trading periods to push the market lower. You do not resist when the exchange raises margins in a way that forces smaller buyers out. You present each sharp drop as a healthy pause, and you hope that this mix buys you time. Time for stock indices to rebalance and take some risk off your hands, time for fund flows to shift metal back into vaults, or simply time for investor excitement to cool. Sometimes that delay works, for a while, but it does not change the fact that the underlying metal is still scarce and that each push lower on the screen can tempt more long-term buyers to remove ounces from the system entirely. Here is where all of this leads. For years now, silver has not been keeping up with demand. Mine supply is flat or falling in important producing countries, while investors and industry are drawing from the same pool of metal. At the same time, more futures traders are choosing to take delivery instead of rolling their contracts. And the people who study this market are openly talking about settlement risk and the chance that, under real stress, an exchange might decide to close out contracts in cash instead of metal. Add in the fact that buyers in the East are still willing to pay extra for bars they can actually touch. And the message is simple. Something in this market is already off. Now put yourself in the seat of a big bullion bank that is short silver. Letting price run to 100 or beyond means large mark-to-market losses, and the headache of trying to source metal in a world where other buyers are outbidding you. Knocking the price down in quiet trading hours can dull the immediate pain, but it speeds up the loss of real metal because every cheap dip encourages strong hands to take bars out of the system and not bring them back. That is the trap. If demand for metal stays firm, each so-called successful smash simply moves ounces from people who trust the screen to people who do not. Behind that is a larger problem that goes beyond silver. Governments in the developed world are carrying debts that would be very hard to pay back in honest money. There are only a few ways out. They can try deep spending cuts, which voters rarely accept. They can default outright and blow up confidence in their bonds and their banks. Or they can do what indebted states usually do, run inflation above interest rates for a long time and let the value of the money owed quietly rot. In that environment, gold and silver act like lie detectors. When metals keep grinding higher, while bond yields sit below the real rise in living costs, it is a sign that someone is being repaid. In diluted currency, savers, pension holders, and wage earners carry that cost so that states and large borrowers can survive. In that setting, a runaway silver price is not just awkward for officials. It is a giant sign on the highway that says the currency has become a pressure valve for the debt machine. You do not need a secret meeting in a dark room to see why there is an urge to lean on the paper side of the metals market. Slowing that signal does not fix the debt problem, but it can delay the moment when the public fully sees how the burden is being shifted. Whenever silver has a wild move, you will see familiar stories appear online. One line says, the banks are pinning options and will never allow price through certain levels. It is true that options positioning matters and can drive hedging, but no strike is sacred. If the squeeze in real metal and investor demand is strong enough, those levels are overrun and the same banks are forced to chase. Another line says, force majeure will be declared any day now, and that exchanges will simply refuse to deliver. What we actually see so far is stress, delays, high lease rates, heavy drawdowns in some inventories, and serious discussion of force majeure as a risk scenario, not a completed event in silver. The risk is real, but it lives in that tension, not yet in an outright refusal to deliver. A third story claims miners, especially in Mexico, are secretly hoarding and waiting for triple-digit prices. What we can say is that regulation, taxes, and new mining rules are making it harder to fund projects and explore, which is enough on its own to tighten supply without adding a grand plot. The pattern we have walked through does not need a master conspiracy. It only needs a tight physical market, large short positions, and a paper system that can still be used for now to manage appearances and buy time. None of what I have said is financial advice. I do not know your personal situation, your appetite for risk, or your time horizon. All I can do is tell you how I read this as someone who has watched metals for many years. I focus on 3 dials. First, the level of price and the way dips behave. I do not fixate on every tick. I look at the shape. Do new highs drift into quiet consolidation, or do they trigger sudden sharp drops in thin trading hours while other major assets stay calm? The more a move feels like that recent overnight slam, sharp, isolated in silver and concentrated in off hours, the more I file it as tactics from the first stage of the play, not the end of the bull run. Second, I watch the gap between Western prices and what buyers pay in the East for real metal. When places like Shanghai are consistently bidding more than the futures price, and that gap refuses to close, that tells me the shortage is not a theory. It is being written into actual transaction prices. Third, I study the curve and the delivery data. When the nearby futures months trade below the spot price and borrowing metal becomes more expensive, it tells me people care more about having silver now than about promises later. When a meaningful share of open interest ends with bars leaving the warehouse instead of contracts simply rolling forward, it tells me more players are choosing to step out of the paper game. When all three dials point the same way, violent dips and thin hours, stubborn Eastern premiums, and regular signs of stress in the curve and in deliveries, then for me, the screen price becomes a delayed summary, not the main truth. The real story is in the plumbing. And before we finish, let me leave you with something you can actually do. If you never want to lean on headlines again, you can watch the same three signals we have been talking about using simple public data. First, look at how price behaves when silver makes new highs. Not every tick, but whether big red candles keep appearing in thin trading hours while other major markets stay calm. Second, from time to time, check what buyers in major Asian hubs are paying for real bars compared with the Western. Futures quote. If that gap stays open and the East keeps paying more, you know the shortage is still there. Third, pay attention to the general direction of the plumbing news rather than every technical detail, whether large funds and exchanges are losing inventory or gaining it, whether margin changes and delivery delays are becoming more common or less. Those three checks will not tell you the exact price tomorrow, but they will tell you whether stress in the system is rising or fading, whether paper and physical are moving closer together or further apart. Once you can read those signals for yourself, you are no longer at the mercy of whatever story gets wrapped around the next big move on the chart. You can see for yourself whether the system is calming down or slipping deeper into strain. Maybe you never touch a futures contract. Maybe you do not own a single ounce of silver. Maybe your wealth sits in stocks, property, or cash. It still concerns you because the pattern we have traced here is the same pattern that shows up whenever a system built on heavy debt tries to manage reality with financial tricks. At first, rules and thin liquidity are used to muffle an uncomfortable signal. Then, the stress leaks into another part of the map, in this case, higher premiums for real metal. Trust in future promises erodes, so people start paying up for what they can hold now. Derivatives are used to buy time, and in the end, the underlying asset, the thing you can actually pick up and move, forces a new price that the paper world can only follow. In bonds, that appears as higher yields and rising default risk. In currencies, it appears as inflation and lost purchasing power. In silver, it appears as a wider gap between the number on the screen and the cost and hassle of getting bars into your own hands. You have now seen the parts of this process that most people never notice. So I want to leave you with a straight question. Right now, what do you trust more? The quote that flashes on a trading app, or the time, premium, and paperwork it actually takes to get hold of metal where you live? Look around your own world and use that as another data point. Are premiums at local dealers going up or down? Are delivery times getting shorter or longer? Do people around you even know that silver is near $90, or does it still feel like something that sits off to the side? Because in the end, this is not just about one metal. It is about learning to see, in real time, how a highly leveraged financial system behaves when it finally runs into the hard wall of physical reality. Thank you for watching, and please subscribe and like the video. Nothing in this documentary is financial advice. Always do your own research and consult a licensed professional before making financial decisions.